Yes, sir. Piyush this side. Good evening.
Good evening, Piyush. Good evening, everyone.
Good evening, sir.
Good evening. Sir, so we have currently 13, 15 participants right now. I think we
We
can.
can we can start with so that we conclude timely.
Okay. Okay. Sure, sir. That will not be a problem. I think जो और भी participants है वो add होते रहेंगे. So that will not
Yeah.
be a. So just to start, so just to start, sir. First of all, I would like to welcome everyone. So, good evening, everyone. I am CA Piyush Shakar, President of Jaipur Chartered Accountants Group, and it gives me immense pleasure to welcome each one of you today for the webinar. It's my privilege to welcome our esteemed speaker, CA Bhupendra Mantri, sir. Sir is widely respected for his practical approach, deep technical expertise, and his ability to simplify complex financial reporting and audit matters. And he has been uh, top for the audit matters precisely in Jaipur right now. So today's topic is about year-end closing, common mistakes and practical insights. As we all know that we are heading towards the closing of financial statements, so this is what we choose for, and it is extremely relevant for all the chartered accountants and finance professional to understand the nuances of financial statement finalization. So we are truly grateful that sir has taken time out of busy schedule wherein he is already busy with the finalization to share his knowledge, his expertise on the nuances and the practical approach which we keep while finalization of the books of accounts. On behalf of entire JCAG family, now I would like to extend heartfelt welcome to all of you who have taken time to join this session. Without taking much time for anyone, I would like to call upon Sir Bhupendra Mantri sir to just take over the session, and we are here to listen to you to for the entire 1.5 hour next 1.5 hour. Thank you, sir.
Yeah, thank you, Piyush. Thank you for inviting me to this Jaipur Chartered Accountant Group uh, for sharing my thoughts on the subjects. So basically, we shall be discussing the year-end closing related to the books of accounts, and the major focus would be the common error which are being there. So instead of discussing the various provisions related to the company law or the recent guidance note on preparation of financial statements for LLP as well as other non-corporate entities. What I have done is in my entire presentations, uh, there were various observations which were there by the Quality Review Board, Financial Reporting Review Board, as well as Tax Audit Quality Review Board. So my major focus would be to discuss those observations, and also uh, whatever experience I have, I will try to discuss uh, certain practical aspects also while discussing these observations. Hope that is fine with the organizers.
Yes, sir. That's the
Yes,
agenda of
yes,
this session.
yes, yes. So My screen is visible. I am sure presentation is visible to all.
Yes,
Yes,
sir.
sir, it is visible.
Okay. It is moving also.
Yes.
Yeah. So first, what I have done is I have taken certain observations from the quality review board's exercise as well as FRRB, wherein there are observations related to the accounting standards. So what I have done is I have prepared this presentation mainly focusing on the entities who are complying with the accounting standards only and not with the Indian accounting standards. They are being large size entities. And then more focus would be on small companies as well as non-corporate entities and LLPs whose financial statements are to be finalized by now, by in the month of August as well as the September, I can say. So first, I am taking certain observations related to disclosure related to the accounting standards. So AS1, there were certain observations like case basis is used for the gratuity instead of the accrual basis of accounting. So we all know that there is AS15, which suggests accounting of uh, accounting by the entities uh, according to the AS 15. And friends, please mind it that AS 15 is applicable on all entities. It is not that it is not applicable on proprietary concerns or partnership firm or any small company also. It is applicable on them also. Of course, there are certain disclosure exemptions. So as I initially said, I will not be discussing those, technicalities of the provisions which are there in the various, say, company law or accounting standards. But mind it that wherever you have certain number of employees or you are required to pay the gratuity or any other employee benefits, you need to ensure that accrual basis accounting is being done. And generally, this accounting is not done by the companies, or rather, companies generally do, but LLPs and non-corporate entities are not doing such accounting. So one need to ensure that this is being done. No policies disclosed for leave encashments, goodwill, factoring claims, rental income, investments, government grants, borrowing cost. So these were the general observations. Uh, see, the idea is that whenever we are auditing any financial statements, we need to see that what are the major line items in the balance sheet as well as statement of profit and loss. And looking to those major line items, one need to ensure that uh, the accounting policies with reference to those line items is properly reflected in the disclosure of accounting policies, which is required as per AS 1. Then revenue recognition policies are incomplete. So one need to ensure that the complete accounting policies are also there. If there are, revenues from the sale of the products, revenue from the sale of the services, or any other revenues like interest and dividends. So one need to ensure that all items of the revenue are being covered in our accounting policies. Then amortization policies inconsistent with the actual method used. So one need to also ensure that whatever accounting policy is being there in the reported in the financial statements, the same accounting policy is actually followed. So that inconsistency should not be there in the accounting policies. Then another standard I'm taking is AS2 and related to the inventory. So there, uh, in fact, the principle of valuation of inventory is cost of NRV, that is net realizable value, whichever is lower. Whereas many entities have used the word market value instead of net realizable value. So that is not a correct approach. Correct wordings which is being there in the which is being used in the financial statements. Then interest wrongly included in the inventory cost. So uh, if if inventory is not being if interest is not accounted for as per A16, where inventory is taking the a larger time to be prepared, to be produced. So there interest can be charged to, interest can be uploaded on the inventory cost. Otherwise, interest cost cannot be part of the inventory cost. Then auditor relied solely on the cost auditor without independent verifications. So for inventory, one need to verify. Auditor also need to verify at their own instead of relying on the only on the cost auditor. Then cost formula for finished goods not disclosed. So and FIFO oblique weighted average stated, but only FIFO is followed. So whatever method is being followed, that method should be reported. That method should be reported. If you are following FIFO and weighted average, then actually you should follow that method with reference to the various inventory items. And in many cases, particularly in Jaipur, I received certain inquiries that whether we can follow the LIFO method also, last in and first out. And particularly certain entities, firms, proprietary concerns who are engaged in the jewelry industry. So they wish that their stocks would always be at a low price. So therefore, they generally wish that they should follow the LIFO method. But LIFO method is not at all be permitted by the AS2. So one need to ensure that this method is not followed in any of the entity. Now coming to the next AS3 cash flow statements. So here in operating activities, short-term borrowings were generally included, wrongly included. So one need to ensure that the short-term borrowings are part of the financing activity and not the operating activity. Similarly, whenever there is property, plant, and equipment which is sold, so its profit should also be part of the investing activity and not the operating activities. So these are certain items which one need to consider. Then in investing activities, property, plant and PPE purchase or sales were not reported. So they were reported in the operating activity itself. So one need to ensure that the proper classification of operating, investing and financing activities is there in the cash flow statement, because otherwise the operating cash flow as well as other cash flows will be misleading to the users, users of the financial statements. So one need to ensure that the classification is in accordance with the AS3 cash flow statement. Now these are certain more accounting standards where uh, uh, there were the mistakes which has been observed by the Quality Review Board and FRB. So contingencies, provision for doubtful debts not recognized, and hence profits overstated. So generally we feel, so it may be related with the AS29 also. So sorry, not AS29. AS29 is with reference to the provision for your liability side, and this provision is provision for doubtful debts. So one need to ensure that uh, all the debts which are being not realized and uh, huge time gap is there. Say they are outstanding for more than 2 years, 3 years, or 5 years, and even then they are actually continuing in the financial statements. And all the time assessee, or you can say the auditee, represents you that these are recoverable, whereas no correspondence, no confirmations are being received from such trade receivables. So in that case, one need to ensure that proper provision is made for such amounts which are not realized. So very, very important aspect, because just to show the profits, sometimes the auditee may avoid to make any provision with reference to these doubtful debts. Then prior period items. So prior period income tax is not recognized in the profit and loss. So whenever, suppose there are tax liabilities which is related to the earlier years, so that should be reported appropriately in the profit and loss statement. Then deferred tax adjusted in the reserves instead of disclosures. So such practice of adjusting the deferred tax adjustment in the reserves and not deferred tax adjustments, many times the auditee comes with lot of different innovative ideas, where they always try to mislead the users or show the higher profits, or even lower profits also sometimes. And in that case, they always come out with an opinion that why not we adjust it with the reserves. Likewise, suppose a depreciation effect. So suppose there is prior period depreciation. So that prior period depreciation should go through only the profit and loss only, and not it cannot directly go to the reserves. So any such innovative accounting should be avoided by the auditee, and we should be careful while looking to such accounting. Then revenue recognition. So uncertainty conditions omitted. So we all know that revenue is realized when it is certain that yes, amount of the consideration will be received by the entity. So in accounting policies, as well as while accounting, one need to ensure that the revenue is properly accounted for, and only when it is certain, then it is being accounted for. If there are export sales, then proper accounting should be reported. Dividend policies, if the company has invested into the shares and securities and expecting to receive the dividend or has received the dividend in the current year, then accounting policy with reference to the dividend as well as the interest should also be there. With reference to AS10 property, plant and equipment, the capitalization policy is not aligned with the available for use criteria. So basically, the property, plant and equipment is generally accounted for when it is available for use. So many times, actual use of the property, plant and equipment is not started. But there are certain properties, certain items which are available for use. They are not lying in the store, but you are not using, but they are available for use. So moment they are available for use, uh, uh, depreciation on such property, plant and equipment should be started. Mainly this issue comes for the items like stores and spares. So stores and spares which are required to be capitalized as per the criteria laid down in AS10, then even though they are actually not used in the plant and machinery and they are lying separately, even though they are considered as available for use, and depreciation on such stores and spares should be charged. Fixed assets, use of the term fixed assets is no longer there now. Now even in the AS10 accounting standard 10, the terminology used is property, plant and equipment. So one need to ensure that at all places we use the terminology of property, plant and equipment and not fixed assets. Then AS11 related to the forex. So transactions recorded at realization date, not transaction date. So Uh, Again, many a times uh, the entities instead of accounting for the forex loss or gain, they generally account for what actually has been realized. So the entire sale has been reported as at the realized amount instead of showing the uh, foreign exchange gains or losses. So one need to ensure that proper accounting of the foreign exchange transactions is done as on the transaction date. And the AS11 very well prescribes that these transactions rates can be, suppose there are very less transactions and exchange rates are not so fluctuating, then one can take a week's average or a month's average also for the purpose of reporting such transactions. Then government grants. So the policy related to the reasonable assurance of compliance with the condition is missed by the entities. AS 12 actually requires that to account for the government grant, even when received, or there is a reasonable assurance that the company will comply with the conditions or has complied with the conditions, and therefore they will receive the amount of the government grants. So once the company has or the entity has complied with the conditions uh, of the subsidy scheme, then such amount of subsidy should be recognized. So whenever there is such assurance, it should be recognized. Now coming to the other standards, AS 13, that is investments. So fair value is not considered for current investments. So AS 13 especially mentions that current investments should be recognized at fair value or cost, whichever is lower. So determination of fair value is important for the investments, and if the fair value is lower than the current cost, then it should be that that should be recognized. So any policy which states that current investments are recognized only at cost is incorrect. The fair value factor should also be there in the policy. Then dividend wrongly shown under the operating cash flows. So observations related with cash flow, it should be basically as a investing activities, not cash flow, not operating activity. Then non-current investment policy omits provisions for non-temporarily decline. So if there is a permanent decline, then uh, the provision should be made for even for the non-current investments. So policy should clearly mention this. Then employee benefits, I initially mentioned while discussing AS1 that the gratuity and all other employee benefits should be provided on the basis of actuarial valuation. And this is applicable for all type of entities whomsoever are required to make the payment as per the make the payment of the gratuity or any other employee benefits. So they have to actually get their uh, liability provided as per the actuarial valuation. So projected unit method not used for determination of the gratuity liability. Defined benefit obligations, service cost, actuarial gains, losses not disclosed, and then all those disclosures which are being given by the uh, actuarial valuer. So all those disclosures are also required to be reported in the financial statements until and unless there is any specific exemption with reference to the small entities. So all those criteria related to level 1, level 2, level 3, and level 4 entities are separately defined by the institute. So one need to consider that which exemptions can be availed by any of the entity. And suppose any entity is availing the exemption from any of the accounting standards requirement, Then again, there is a requirement that yes, they have to mention in their notes that these exemptions are being taken by them while reporting. Then borrowing cost, financing cost capitalized till put to use instead of ready for use. So uh, borrowing cost should be capitalized till it is ready for use, and policy merely, sorry, states that as per age 16. So one need to, it is not about age 16 only. Whatever accounting policies are being written, we need to write it in a detail. We cannot write that we are accounting for the revenue as per age 9, or we are accounting for the borrowing cost as per age 16. We are accounting for the investments as per age 13. So such single line cannot be mentioned for any of the in any of the accounting policy. One need to properly mention the accounting policy in detail. Yeah, A17 segment reporting. So in many cases, the segment reporting is actually required to be done. Uh, One need to report that what are their business segment as well as the geographical segment, and based on that there are reporting requirements. So one need to properly assess that whether segment reporting is applicable on the auditee or not. And once this is applicable, all the segment assets, segment liabilities, depreciation, capital expenditures, and revenues from the different segments. So whatever that table is required, that table should be disclosed. And mind it, friends, in many organizations, a proper assessment is not done by the auditee that whether segment reporting is applicable or not. So uh, one need to guide the auditee also that yes, if these are applicable, these should be reported. Then related party disclosures. So nature of relationship with the associates, group company, not disclosed. Who is the controlling shareholders? So their names are not disclosed. Outstanding related party balances are not disclosed. Long-term loan from related parties are shown under the payable instead of borrowings. So these are various observations which are being observed by the quality review and FRRBs, that proper reporting of the related party disclosure is not done. Then AS19 leases expenses not recognized on the straight line basis. Renewable options, escalation clauses, and various other disclosures related to AS19 are not done. In many entities, basic and diluted EPS, particularly it is applicable on companies only, are not disclosed on the face of the profit and loss. So rather, it has been disclosed elsewhere in the notes on accounts. And numerator as well as the denominator are also not properly disclosed, as well as their reconciliation is not properly done. So these are the observations related to AS 20. Then AS 22, accounting for taxes on income. I have not taken the AS 21 because that is consolidated financial statements and generally applicable to uh, large companies also. But in AS21 also, suppose even there are small companies and they have further invested some amount of money into another company and acquiring more than 20% of their shareholding, then even such small companies may be liable to prepare their financial statements as per AS21. So consolidation statement, even if there is one associate, then also the consolidated financial statements are required to be prepared by the entities, and uh, maybe that there is subsidiary or not. So, but many times the companies do not prepare CFS if there is only associate or joint venture and there is no subsidiary. So that is not the correct practice. Now, AS 22, accounting for taxes on income. So, at many places, the deferred tax assets or liabilities is computed based on the block of assets. of the fixed assets of the which are actually available for depreciation as per the Income Tax Act, but it should be actually based on the timing differences. Timing differences is the value in the uh, as per the Income Tax Act, as well as the value which has been recorded in the books of accounts. So their difference is considered to be the timing difference, and the deferred tax should be computed on such timing difference. And then the policy of virtual certainty. So basically, AS 22 says that when there is, the probability that the losses will be realized. So it is basically a reasonable certainty case and not a virtual certainty in case of AS 22. So one need to ensure that even if there is reasonable certainty, then deferred tax assets can be recognized. Then deferred tax liability is shown as negative figures. So if it is a deferred tax liability, then it should be shown at your in the liability side instead of showing as negative in the asset side. So one need to ensure that negative figures does not come even for liability as well as for the assets. So, and then evidence for DTA recognition not disclosed. So wherever there are losses and unabsorbed depreciation, and on that suppose deferred tax asset is recognized, then standard says that the disclosure of the evidences, that yes, these are the evidences based on which the DTA is recognized. So description of those evidences should also be there in the notes to accounts. So that description is not found by the quality review board in the financial statement of various entities. Then AS 26 intangible assets. So uh, uh, generally R&D policy is does omits the research expenses treatment as well as the development phase criteria. So basically AS 26 requires that whenever there are expenditures on research and development, so all expenditure on research should be charged to profit and loss, and all other and the expenditure which are there on the development phase. So if those 6 criterias which are mentioned in AS 26, they are satisfied. So moment all the 6 criteria are satisfied related to the marketability, availability of the products, and whether it can be actually sold in the market or not, technical feasibility. So all those 6 criteria, if they are satisfied, then the any expenditure which is incurred on development phase should be capitalized. So proper accounting policy should be there with reference to such expenditure. And then the use of the word amortization of intangible asset should be there instead of use of the word depreciation, because intangible assets are amortized and not depreciated. Is 29 contingent assets wrongly disclosed. Additions, usage of provision not shown. So basically, whenever there are provisions which are being accounted for, the AS require that there should be a journey of provisions for from the present year to from the opening balance to the closing balance, additions, withdrawal of the provisions or use of the provisions. So that entire journey should be disclosed in the profit and loss. And disputed income tax should be disclosed in the notes on accounts. Disputed income tax liability are not disclosed. So not only with reference to the income tax, wherever there are disputed liabilities, the auditor need to make inquiry in accordance with the AS SA 501 and find that if there are any contingent liabilities, then they are properly disclosed in the notes to accounts. So these were the various observations which I thought that should be discussed. with reference to accounting standard. Then there are observations with reference to the Schedule 3, Division 1. So, trade payable and borrowings. So, the classification of MSME versus non-MSME bifurcation is not shown on the face. So, Schedule 3 requires such bifurcation on face of the financial statements. So, that should be there. Maturity analysis is missing. So, in trade payable, we all know that in 2022, there were requirement with reference to the disclosing the trade payables that since when they are outstanding. So that maturity analysis is not done. Then long-term borrowings not classified as secured and unsecured. So one need to ensure that all the long-term borrowings they are properly classified as secured and unsecured. And then repayment terms are not disclosed. So these are basically requirement of Schedule 3 itself, Division 1. So we need to ensure that all the relevant requirement with reference to Schedule 3 are complied with by the entities, by the auditee in their financial statements. And now similar requirements are also there in non-corporate entities as well as the LLPs. So recent guidance note, which was earlier deferred for this year, and now on 31st March 2026, the institute has clarified that the entities which has turnover of more than 5 crore rupees have to comply with that guidance note from 1/4/2026 and 2025. So basically for 25-26, that guidance note, those two guidance note, one on non-corporate entities and other on LLP, are applicable for the entities whose turnover are more than 5 crore. And for the other entities having turnover less than 5 crore, the guidance note will be applicable from 1st of April 2026. That is for the financial year 26-27. So one need to take care on this. Then asset classifications. So capital advances wrongly classified under the short term. So basically, whenever there is a capital advance, since that capital advance is ultimately going to convert into the fixed property, plant and equipment. So these capital advances are treated as non-current and not current. So they cannot be treated as short-term advances. They should be classified as non-current. GST input credit under loans instead of other current assets. FDs greater than 3 months are classified under the cash and cash equivalent. So one need to ensure that such FDs are required to be classified as bank balances only and not as a cash and cash equivalent. Then investments are not classified as quoted or unquoted investments. So these are various basic things. So what I suggest is that you should guide your team that they take all these literature with them or they take certain checklists with them, and from that checklist the financial statement should be properly reviewed, and wherever there are errors or there are something which is missing, those should be properly identified and reported in the financial statements. So provisions and contingent liabilities, defined benefit obligations under other long-term liabilities instead of long-term provisions. So basically, since these are the actuarial valuations, these are more in the nature of the provisions and not liabilities, because they are not, amounts are actually not certain. So these are made on the estimate basis only. So these should not be classified as liabilities, rather these should be classified as provisions. Then audit fees, electricity, telephone under provisions instead of other payables. And then inventories and receivables. Breakups not disclosed. Stores and spares not shown separately. Trade receivables not subclassified as secured, unsecured, doubtful. Allowance for bad debts not shown separately. Then share capital and reserves, rights, preference, restrictions not disclosed. Promoter shareholding is incorrectly disclosed. Then securities, premiums, reserves, proper terms have not been used. So shareholders greater than 5% are not disclosed. So these are the requirements under the Companies Act. So one need to see that disclosures as per Schedule 3 of the Companies Act are complied with. Similarly, profit and loss items also, administrative and selling expenses, words has been used instead of the other expenses. So Schedule 3, the profit and loss requires the terminology of other expenses and no administrative and selling expenses. Then revenue from products and services not disclosed in the notes. So many companies in the profit and loss as well as in the notes written only the gross revenue which they are received. Product-wise bifurcations or services-wise bifurcations are not done. Then duty drawback under the head other income has been reported instead of the other operating revenue. So duty drawback, since it is related to the the operations of the entity, it should be recorded as other operating revenue. Director remunerations are recorded as uh, other expenses. Rather, these should be recorded as employee benefits only. Then auditors payment breakup is also not disclosed. Then cost of internal audit fees, cost audit fees, they are also clubbed with sometime with the statutory audit fees only. So here the payment to auditors means only to the statutory auditors should be reported here. To other auditors, if there is any payment, they should not be reported under this particular head. So these are the certain observations related to the profit and loss. Then guidance note, the capital items payable, they are wrongly shown as trade payables. So if there is any payment which is required to be made for the capital item purchase, they are not considered as trade payable. They are considered as other payables only. Then current maturity of long-term debts under the current liabilities is reported. So I think in 2022, there were certain amendments where such current maturities were required to be reported as short-term borrowings and not other current liabilities. So one need to take care of such reporting. Then share application money pending allotment. So wherever there is any pending allotment, the expected completion date is required to be disclosed. So such date were not disclosed. Then in CHR expenditures, the breakups as well as the related party details that to whom CHR expenditure have been paid should also be disclosed. So basically, whenever we are preparing the financial statements, one need to see these assertions about the class of the transactions and the events for the period under audit. So while auditing, one need to ensure that whether that transactions has actually occurred or not. And once it is being justified that yes, transaction has occurred, then it should be ensured that it pertains to that entity or not. Because many times, whenever there are group entities, you may find that the bill is in name of some other party and it is being recorded in name of the other party. So one need to ensure that whenever you are auditing or whenever your client is preparing your financial statement, uh, whether that transaction which has been recorded has actually occurred or not, and then if occurred, whether it relates to that entity or not, because many times such mistakes also happens. So that should be the spirit while auditing the financial statements. Then completeness, one need to see that all transactions that were supposed to be recorded have been recorded. So we need to ensure and plan our audit in such a way that we are able to verify the completeness of the transactions. Then accuracy. So transactions have been recorded accurately at their appropriate amount. So and particularly whenever we are making the provisions, the accuracy is very, very important. Then we need to also follow the cutoff procedures that transactions have been recognized in the correct accounting period. So all liabilities, you know, uh, as on the year end, one need to see that if they pertain to the year under audit, say financial year 25-26 in the present scenario, then that should be properly accounted for. Then classifications, transactions have been classified and presented fairly in accordance with the various guidelines. So these are the assertions. I am just escaping these discussions, which is more theoretical in nature, I can say. But then these are the certain things which one need to take care at the year end while reviewing the periodicity of the various expenses. So whenever there are outstanding expenses, audit expenses, security guard, power and fuel, salary, housekeeping, these are the various recurring expenditure. So we need to ensure that all the 12 months expenditures are accounted for in the books of accounts. Accrued income, if there are, operating income, rental incomes, many times client may just account for what has been received. Rather, the accounting should be done what has been accrued. So we need to ensure that all the accrued income are accounted for. Then prepaid expense, insurance expense, if they are material in nature, then such prepaid expense should be accounted for uh, in the period. Only the related amount should be accounted for in the year under consideration, and the rest of the amount should be treated as prepaid expense and should be classified as asset. Then unearned income, booking of entries for all 12 months, reasonable consistency in monthly booking. So we need to also ensure that your client is regular in doing their accounting or not. And mind it, this rule 46.8, many of us you have seen, which is now circulated that now I'm not sure whether it is draft rule or something else, that entities are required to take their backup on daily basis. So that means that whatever, whatever transactions are being there are now required to be accounted for on daily basis. So this is of course not applicable for the previous year, but now it will be made applicable. Uh, some CBDT circular or some rules
Sir,
is being circulated. Yes,
I have a doubt in previous slide.
yes, please.
In outstanding expenses, we are showing depreciation here. So I have a doubt on this.
Your doubt is correct. Maybe that some of my team member may have written it over here. There cannot be any outstanding depreciation. Uh, I was just checking whether you are hearing me or not.
Okay. Okay, sir.
Thank
Thank
you for pointing out. Yes. So, other periodic considerations like, GST monthly ITC utilization from monthly output liability, depreciation for new assets disposed of during the year. So all these, suppose some depreciation, some assets has been disposed of, then their depreciation should be there up to that period only and not for the subsequent period. So these are certain things which one need to keep in mind while looking at the financial statements for this year. Then provisions, present obligations can be measured only by using a substantial degree of estimations, probable outflow of resources. These are certain examples. So now I'm coming to various reconciliations. So one need to ensure uh, bank reconciliations, very, very important aspect. And friends, many times I see that when our team members, like, article assistants and other staff goes and they see that there are reconciliations, then they actually just obtain the reconciliations, particularly the bank reconciliation. And they do not see that what are actually uh, items which are not reconciled or items falling into that reconciliation. And what is their impact on the financial statements? Suppose there are certain reconciliations because of which actually one is required to make some accounting entries, then that entry should be done instead of obtaining such reconciliation. So please take care that only obtaining the reconciliation is not sufficient. Whatever items of reconciliations are there, what is their impact on the financial statement, that should be ascertained, and that impact should be given in the financial statements. Then inter-branch reconciliations, again, very important aspect, because suppose we are sending our goods from one branch to other branch within the state as well as the outside state. Then also when we are sending, say, within the state, so it may be inter-branch transfer without recording sales. But then suppose there is any sales which has been recorded, then that sales should be eliminated, and the balances of both the branches should match. So that thing, and suppose it is inter-branch sale outside the state. So in that case, the GST law requires that you have to issue the sales invoice. So though it is a inter-branch sale, a sales invoice is generated. So your financial statements of one branch may include a sale to yourself. So for the purpose of preparation of the financial statement, that sales should be excluded. Similarly, there are, suppose intergroup transactions, then elimination should be there. Reconciliation should be there with 26 As as well as the GST portal. So it is very obvious that the turnover which has been shown in the GST portal may be different than turnover which is actually shown in the financial statements. And that may be for n number of reasons, like this one of the inter-branch sales. So in that case, the proper reconciliation should be there with the client. And as an auditor, we should also verify that yes, these reconciliations are correct. And if there is any necessary accounting adjustments which is required to be done, then that adjustment should be done in the financial statements. Physical verification, a very important aspect, friends, particularly with reference to the inventory. So physical verification of cash. So whenever we are doing the audit, the standard do not require that it should be as on the year end date only. So whenever you are doing the audit, you can go for the physical verifications, or you can go for a physical verification of cash in between the year also. Then that cash verification should be done by the client in our presence, or we may also assist while doing that physical verification. Then physical verification of inventories. So our standard on auditing SA 501 specifically requires that inventory physical verification, there should be a proper system by the uh, entity, and it is applicable on all. It is not that the standards on auditing are applicable only on uh, companies or large size entities. When you are doing, we are doing the audit of the financial statements, irrespective of the category of the auditee, standards on auditing are applicable on you. So you need to ensure that whether proper system exists or not for the purpose of ascertaining the existence of inventory by the entity. And the standard also requires that whenever that team is conducting a physical verification, your team should also be there present and should have some test count of the inventory items. And then, of course, whatever ultimately physical verification is done, how it is valued from the books of accounts and all that, that should be done. So, very important aspect. And rather, I would say that these two standards on auditing, particularly for small companies, small entities, One is SA 501 and then verification of inventory, and other is SA 505, that is external confirmations. If these two standards are properly followed in any audit, I would say that 95%, 99% of audit is done, because everything comes out whenever these two standards are properly followed. I will come to the external confirmation later. And then we should also, avoid the use of the word inventories as certified by the management. So in many small entities, even in the companies, I see that the auditee writes that inventory is as certified by the management, and we also rely on.
Sir, you are on mute.
So it's okay now, I think. Yeah. So that practice of, certified by the management and relied by the auditors is absolutely an incorrect practice. One need to ensure that proper standard on auditing is followed while verifying the inventories. Similarly, physical verification of fixed assets. So it is again a very important point for the purpose of reporting under CARO also. So where we report that yes, physical verification is done at reasonable intervals, say once in a 3 years and all that. So, uh, but generally we see that a proper reporting is not done, or even if reporting is done positively, we may find that proper documentation with the auditor is not available. That how the physical verification of fixed assets is actually done. And friends, these all issues, in audit, the entire problem is that when we are auditing, nobody comes. Everyone comes after 1 year or 2 year or 3 year. Maybe it is any regulator, maybe it is any department, or maybe it is any other person. So at that point of time, we may or may not be able to, convince from our documentation to the reviewer that yes, things are properly done by us. So please mind that if client is not doing proper physical verification of their assets, then you should write in your audit report. It is clearly mentioned in the CARO. Then cash review at the year end. I think because there are so many other points also. So one need to see if there is any, negative balance during the year. Many times in tally, because the accountant uh, many times, uh, delay in making the entries and all that. So there may be some negative balances when we run through the entire books of accounts for the entire year. So on some days you may find that there are negative balances. So one need to ensure that proper accounting is being done on timely basis. And if there are regular negative balances, then it may be a cause of concern, that why it is so. Then of course, then there may be n reasons which one need to take care of. Then high cash balance. अगर किसी कंपनी में बहुत ज्यादा कैश बैलेंस है, किसी एंटिटी में कैश बैलेंस है, so that is also a cause of concern and should be properly audited. Then 40A3 and 3A requirement, cash payment more than 10,000 and that disallowance. 269 SS and T and ST. So taking loan from the persons in cash and repayment of loan in cash. So all these things are actually required to be seen while auditing the cash. And not only cash, even the bank balances also. So whenever it is high cash balance or high bank balance, proper audit is required to be done. Then review ledgers and group restructuring at the year end. So correct nomenclature of the ledgers. So this is again very important. Many times, people write petrol expenses. So petrol expenses is not a, even when we are hearing, it feels that it is not a proper term. So one can write the conveyance allowance or fuel expenses. Then correct grouping is also required. So trade payable versus advance to suppliers. So many times advance to supplier is merged with the trade payables, and trade payable is actually shown at a lower amount. And similarly, the case may be with the trade receivables also, where there is advance from the customers. So when grouping is being done, we need to ensure that the all negative balances are shown separately. A negative balance in the trade payables should be shown as advance to supplier, and negative balance in the trade receivables should be shown as advance from the customers. So these and proper grouping should be there. Then grouping related to the related parties as well as the loans to companies, LLPs, these should be there. Duplication of uh, any item like salary expenses, then staff salary expenses. So two, three account are being opened by the entities auditee uh, in the books of accounts. So that duplication should be avoided. Valuations related to the inventories, current investments, foreign currency balances, and going concern challenges. All these aspects should be looked into. Some of these things I have already discussed. Then balance confirmation letters. I was just earlier saying regarding SA 505. So I think many of the balance sheets, financial statements, it is found that people write that balances of debtors and creditors and loans, receivables, loans givens are subject to confirmation. I think this line is very, very damaging and it should be avoided. Once if anything is balances are subject to confirmations, that means your creditors are subject to confirmation. Once your creditors are subject to confirmation, that means whether your purchases are also correct or not. So one line item of profit and loss, one line item of balance sheet, they are subject to confirmation. Similarly, if debtors are subject to confirmations, that means whether your sales is proper recorded or not, you are not aware. So writing subject to confirmations means that major line items like profit and purchases, sales, debtors, creditors, they are not verified by the auditors. So if this is the case, then is it a case of disclaimer? So one need to ensure that proper balance confirmation process is followed. And the whole issue is the timings. But friends, as a chartered accountant, as a auditor, we need to ensure that uh, all these things are done timely. We need to assess the risk which is there in the client's financial statements. Because once we are not able to properly write the confirmation letters and something comes at a later date, then it may be a uh, it may be a it may be causing certain problems to us. So one need to ensure that proper balance confirmation letters are sent by the auditors to all these parties, to vendors, to lenders, to banks, to borrowers, to intergroup companies, then all other material parties. So SA 505 requires that we as an auditor send these letters ourselves. So these letters are not required to be sent by the company. We have to send it ourselves. So please see that whether this process is followed or not. And these days, sending such letters is not a big task because you can send all these things through your email also. And after that, if suppose confirmation is not received, then you need to ensure that subsequent transactions are verified by you or not. So suppose 31st March confirmation letter is being sent and there are certain parties who are not providing any confirmation. So the standard provides an alternate procedure that you can go into the that particular party's ledger balances and see whether the amounts are received or amounts are paid to them or not. And based on that, you can record that yes, these balances are confirmed because there are certain transactions in the subsequent periods with these parties. And mind it, the balance confirmation process uh, actually helps you in correcting your financial statements, in correcting the various ledger balances, as well as in correcting your sales and purchases also. Because whenever such confirmation comes and they say that there are certain items, there are certain transactions which are not reflected or balances are not proper, then reconciliations are required to be done. And in these reconciliations, you may find that certain correct accounting entries are required to be done by the entity or by the auditee. So a very, very relevant audit process which is required to be done by the entities. Similarly, balances review and clearances. तो वेंडर्स एडवांस टू सप्लायर्स इन सब का रिव्यू आपका प्रॉपर होना चाहिए. Most things I discussed. And then with reference to, so far what I discussed was with reference to the accounting. Now for another 20-25 minutes, I shall be discussing the compliance of standards on auditing as well as certain observations which are being given by the Tax Audit Quality Review Board, TAQRB, of the institute. With reference to the standards on auditing, overall objective is that SA 200, that no confidentiality undertakings from the audit team members. So whenever we are auditing, we should have certain quality control procedures in-house, and we should take the confidentiality undertaking from our audit team members that they are auditing, but they will not disclose any of the facts related to our client presently as well as in any future also. So that such declarations should be there. Declaration related to the independence should also be obtained. Then professional skepticism not exercised or documented. So whatever, it means that whatever your observations were there, whether you have actually asked it from your client or not, from the auditee or not. So that should reflect in your documentation that whatever your observations there, you have actually communicated it to those charged with governance or to the proprietor or to the partners of the firm, to the board of directors. So inadequate working papers on the judgments. So whatever judgments you have taken, that should be a proper working paper. Then engagement terms, no separate engagement letter for internal financial control or financial reporting. So that should be a separate engagement letter as given in the this guidance note related to the IFC of FR. Then management and auditor's responsibilities are not recorded. Then insufficient evidence on law and regulation compliances, no documentation of the governance communications, joint audit responsibilities, not much applicable on our case, but not identified. Then confirmations and verifications, external confirmations for debtors, creditors, bank balances, borrowings. So I think I have discussed this aspect while discussing the other things. Then processes and evidences, insufficient documentations for related party transactions, impairment testing. Suppose your client is running into the losses. So you need to see whether the various assets are required to be impaired or not as per AS 28. So if that is the case, then it has to be impaired. Then CARO assertions, then analytical processes. So in CARO itself, there are a lot of points. Particularly if we see the CARO, you will find that apart from the property, plant and equipment and inventories, the transaction audit is also required to be done, wherein they are whatever loans you have received. So whether it is in compliance with the Companies Act or not, whatever loans you have given, whether it is in compliance with the Companies Act or not, loans to directors are given or not, loans to other related party transactions. So then issue of shares, utilization of the various funds which are received uh, on account of private placement or on account of any public issue. So there are a lot of things which are, transaction audit which has been done by you is required to be reported in the CARO. So uh, all the related process related to the CARO reporting as well as any other reporting should also be properly reported. And then in CARO, particularly in case of companies, there are certain, apart from CARO, there are reporting related to the other matters. There are reporting related to the dividends. Then such reporting should, then there are reporting related to the beneficial ownership transactions. So that reporting should also be properly seen while doing the audit and properly reported. And mind it, for each of the item, there are certain guidance available by the institute. So what is entire problem is, like, there is a guidance note on reporting of dividend by the auditors. So, but many times I find that professionals are not aware of that how to actually report about the dividend, and they generally write the that yes, the there is no payment of dividend during the year, or all the related compliance has been done. Whereas if we see the entire guidance note, then there is an entire table, and wherein there are 9 situations which are explained, and you need to see that in which situation how to report, because the reporting is required with not only with reference to the dividend, it is with reference to the interim dividend also. It is with reference to the dividend which has been declared in earlier year and paid in this year. It is the dividend which is declared in this year and will be paid in the subsequent year. So the all these 9 scenario are being given in the guidance note, and then different reporting requirement has been given. So one need to ensure that all the related guidance note are properly followed by the auditee as well as the auditors. Then file assembly and sign off. So no dates on checklist, no reviewer names, sampling methodology is undocumented. So one need to see that whatever work you have done, the proper dating, time and date stamp, if you are not following any software, it should be there in your file itself. Who has reviewed these items? Because all these aspects are now coming to be there when you will be, getting your peer review done from the peer reviewer. And you must have heard that from 1st July 2026, the entire peer review process will be online. So even your peer reviewer have to verify all these aspects. So you need to maintain your uh, documentation in accordance with the standards on auditing. Then SA 300 planning. So no comprehensive audit plan covering risk assessment procedure, further audit procedure at assessment level, or documentation of strategy changes. So you need to have a proper planning document. And mind it, the institute itself has issued a detailed guidance note on audit documentation itself. That is around 300 to 400 page guidance note, wherein all the relevant formats are given. Only thing is that one have to set a system in their firm and see whether all these templates are properly followed for the audits. And the best way of implementing all these things is that at least you identify your category A, B, and C client, because it is possible that in all the cases, considering the various constraints, it is not possible to implement all these things. But at the same time, at least categorize your client A, B, C, and then who are the bigger clients. In that, all these templates, all these documentation should be done. Risk and materiality related documentation should be done. Response and misstatements, wherever the misstatements are being found. So you need to also have your documentation of misstatement by the auditee uh, as per SA 450, and why those misstatements are corrected or why those misstatements were not corrected. Because in audit, we generally tend to that whatever is being found is required to be corrected. So, but that practice audit does not require. Audit says that if there are certain immaterial items which are not corrected, then also the you can issue the true and fair view. But at the same time, those uncorrected misstatements should be recorded as per SA 450 in your audit documentation. External confirmations we discussed, then analytical and sampling process. So entire, your documentation should reflect that whatever the analytical processes are there, uh, they are being properly documented in your files. So these are various, uh, audit uh, auditing standards on auditing which are required to be followed. Now coming to the auditing standards on auditing related to the audit report. So there also, uh, earlier the audit report formats were there where the opinion paragraph used to come in between. Fourth or fifth paragraph or last paragraph was coming. But now the opinion paragraph is coming first as per the revised SA 700. So one need to ensure that the proper format of the SA 700 is followed while auditing. And SOKI is basically Ind AS item. The wordings of the cash flows should not be omitted. Or whatever, whatever components, whatever items are becoming part of the profit finance statements, balance sheet, profit and loss, cash flow, notes, SOKI. So that should be properly reflected, or reference of all these items should be there in the audit report. So basis for opinion incomplete. Suppose someone is giving the modified report, then the basis for opinion should be there in such modified report. Incorrect reference to the notes. So one must ensure that, suppose we are inviting attention to any of the matter, then the correct reference of the notes given in the financial statement should be there. CAM generally not applicable on small companies. I'm skipping that. But qualification. So here the qualification as well as emphasis of matter paragraph. Many a times as an auditor, we write that we didn't get the sufficient appropriate audit evidence, but we put that observation into the emphasis of matter instead of qualifications. So one need to ensure that proper distinction is done between the emphasis of matter paragraph and qualification paragraph or modification of the audit report. And the matter which requires the modification should be appropriately dealt in the modified opinion, and the matters which requires the emphasis should be appropriately reported in the emphasis of matter paragraph. So that the distinction between these items should be properly reported. Then nowadays one more standard is there, that is SA 720. This SA is related to the other matters wherein, suppose any company is issuing the director's reports and any corporate governance reports or any other report. And in that report, certain financial figures are also coming. So as an auditor, suppose that report is issued as on the date of the balance sheet itself. So as an auditor, one need to compare and see if there is any discrepancy in that report. Or maybe that report is correct and there is discrepancy in the finance statements. If that is the case, either of the two, the auditor should write to the auditee that you need to correct whatever is the correct position. If it is the board's report which is required to be corrected, then that should be corrected. Or if it is the financial statement that should be corrected, then that should be corrected. So that responsibility of verification of such other information is there on the auditors. And suppose by the time it is being audited, that those other informations are not ready, then in that case, the auditor should ensure that whenever such reports, such other informations are there, he verify it and he see it whether it is in contradiction to the balance sheet which he has signed earlier. And if there is any discrepancies, then that should be reported to the those charged with governance or the board of directors of the company. So these are certain observations related to the Companies Act. So sin and din are not reported while signing the financial statements. Then directors signed in individual capacity instead of on behalf of the board. Then auditor's report is not attached with the financial statements approved by the board. And whenever there is company's financial statement signed, the auditor should also take the resolution of the board that yes, they have approved the financial statements. Then CSR reporting failure, correct CSR amounts not debited, required spend not provided in the statement of profit and loss, unspent amount, unspent CSR not transferred to the Schedule 7 fund within 6 months as required by the Companies Act. So, and then detailed disclosures as per the guidance note para 11.5 of the are not given. Then these are the reporting deficiencies which were found in the audit reports. Section 177 and 197, inapplicable provisions. Section 186(4) related to the loans. So this disclosure is required as per the section 186(4), that what is the purpose of loan, what are the guarantees or securities for the recipient. So as per 186(4) also, there are certain disclosure requirements which are required to be given. So that disclosure is required to be given in the company's financial statements. Major observations in the CARO. So discrepancy level not stated, loan contradictions, reported no loans granted, then separately disclosed unsecured loans to the companies and parties. So what has been reported in CARO is that no loan has been granted, whereas the balance sheet says that there were certain loans. So such contradictions should be avoided. Proper verification should be done and proper reporting should be done in the CARO. Then reported no borrowings despite long-term and short-term borrowings existing. So again, I would say that such reporting is basically a gross negligence on the part of the auditor. Then fixed assets, material discrepancies in the PPE verification not reported. Title deeds of the immovable properties. Many balance sheets I have seen that even today they are not reporting about the title deeds of the immovable properties, whereas this is now required to be reported in the financial statements as well as your audit report. But still, companies as well as the auditors are not reporting, which is not a correct practice. Wrongly reported no loans granted despite the related party loans disclosed. Then stage 3 dues related information is not properly given. So I think one need to properly see all these aspects related to the CARO also. Now coming to few observations for next 5-6 minutes in the tax audit quality review board observations on tax audit reports. And in fact, I have prepared these few slides just before I started my presentation at 6 o'clock. So I just took it from the recent draft guidance note on the tax audit. So on 9th of July, yesterday, the institute has released a draft guidance note on the tax audit, which is of around 640 pages. And I have seen that in that guidance note, after every clause, wherever there were certain observations by the tax audit quality review board, after every clause they have shown these observations of the board that yes, while doing the tax audit, you need to consider these observations also. So clause 2 related to certain basic preliminary informations. So there they said that the address reported under this clause differed from the addresses appearing in the annual report and or records maintained with the Ministry of Corporate Affairs. So, these are certain reconciliations which are required to be done. That whatever your authentic documents like, uh, incorporation certificates and any other document, suppose you are a proprietary concern, then whatever license you have received. So the addresses, names, all these should be matched while you are reporting in your tax audit report. Then clause 4, registrations under other indirect tax laws referred to in the Caro report were not fully reported under this clause. Registration numbers reported under indirect tax laws didn't match the PAN reported in the Form 3CD without any corresponding qualification or observation in the Form 3C and 3CD. I would rather say these are, various minor observations, or such observations could have been avoided by uh, by a proper and small verification by your team and small checklist by your team, that uh, by filling a small checklist by your team. So one should, as a company or as an auditor, we should have a process that yes, whenever we are doing audit, the verification should be done from these evidences, and reporting should be accordingly done. Companies whose accounts were audited under the Companies Act 2013 incorrectly selected the clause A, audit under section 44 ABA, instead of audited under any other law as required under the third proviso to section 44 AB. So whenever there is a statutory audit, so the reporting should be that it has been audited under any other law, not 4 ABA. Then codes for all principal business or professional activities were not reported. So I think this is required to be reported when we are filing utility. There this must come. I am not very sure that why this observation is there, but since I am actually not into the direct execution of the audits, so maybe that these codes are required to be reported in the utility itself. The clause 10 does not require, but then clause 11, incorrect reporting was noticed under this clause, including reporting prescribed books of accounts where none were prescribed. So there were no prescribed books. Books are prescribed for doctors and some other categories, but even then, the auditor mentioned that certain books were prescribed for, maybe some other business for which there were actually no business prescribed. Failure to report the location and mode of maintenance of books of accounts, and omission to report relevant supporting documents and records examined during the audit. Incorrect reporting was noticed where adjustments required under the income computation and disclosure standards. So ICDS reporting is also very important. So all the 10 ICDS reporting is required to be done properly. Then deficiencies were noticed in the reporting under clause 14, including non-reporting of inventory valuation method. Then unnecessary reporting was noticed under this clause in case of where actual consideration received and the value adopted under the 43C and 50C of the income tax were identical. So wherever the value were identical, there are no reporting required as such. So it could have been avoided. Then written down value at the year end of the year, additions and deletions reported in tax audit report were not reconciled with the corresponding figures reported in the audited financial statements. So all additions, deductions, this should be reconciled with the financial statements also. So that was not done. So similar other observations related to the clause 18. Then clause 19, reference to the separate audit reports supporting deduction claims. So wherever the deductions under section 33 section group, section 35 group, so there are separate reporting also. Separate certificates are also required to be issued by the chartered accountant. So that reference should also be uh, reported in the clause 90. Then actual date of payment to the concerned authorities should have been reported. So these are not reported. Club entrance fees, subscription fees were reported together wherever there are separate clauses or separate line items, sub line items for that. Late filing fees under 234E has been shown and reported as a penalty, whereas this is not a penalty. This is only a basically interest item only. So these were certain observations with reference to the various clauses which are given by the tax tax audit quality review board, which I have verbatim reported here in my presentation. I will share this presentation with Piyush so that he can further circulate with all the members. So I think MSME compliance is again a issue which need to be seen, whether the payment to these MSMEs have been done timely or not. So a proper verification on the part of the auditor is required for MSMEs also. So I think this was the presentation which I thought that in the given time I should uh, I should uh, discuss all these aspects of the commonly found errors while reviewing the financial statements of the auditees. So I'm thankful to the Jaipur Chartered Accountant Group. I'm thankful to Naman as well as the Piyush for organizing uh, this webinar where I could interact with all of you. Thank you so much.
Thank you, sir.
Thank you.
Before formally going to for vote of thanks, let me see if there are any questions. Participants, if you have any questions, you can ask from sir directly, or you may post your question on the chat box.
I am sure many of you are connected with me on WhatsApp or LinkedIn. So you can always ask questions me directly also.
I think there are no questions.
So I have a question, sir. So when we get into the note for leases, so now with the co-working spaces are coming in and in such kind of structure, there are no rent agreement or lease agreement. So they are service agreements.
Yes.
So
So are these short-term lease or long-term lease? That you need to check first. If these are the short-term lease, say only for 11 months, so it will not come as a lease. It will come directly as an expense. But if it is, say, long-term lease for 5 years, you are saying that you will provide us 2 seats or 5 seats, then that will be termed as a lease because that is an identified assets. That is an underlying assets. 5 seats are the underlying assets.
but sir,
According,
in that
yeah.
particular agreement, they never quantify the fixed seats. So it is like per seat basis. So we are not sure how many seats will be there. They may charge.
So if they have not said that, generally what I have seen is there are two type of arrangements. One is that, I have taken a 1 seat and I can go anywhere, wherever, I find that there is a seat. So that kind of arrangement, you can say that it is not a lease. It is basically they are providing you a facility. You can go anywhere. But at the same time, there are co-working space where they have identified the area that yes, this cabin
Yes.
belongs to this one only. So there it will be termed as a lease only. But generally, I
Okay.
find that most of these arrangements, because since these are with the startups who are taking such things and all that. So in most cases, these will be short term, 11 months or 1 year. Then so if it is a short term, then whether it is fixed or whether it will not be, it will be directly accounted for as an expense.
Okay.
So
Any
thank
other
you
question?
everyone.
I don't think there are any more questions. So let me formally go for vote of thanks then. On behalf of everyone at JCAG, I extend my sincere gratitude to Bhupendra sir for delivering such an insightful and practical session. Sir, I strongly believe that the practical mistakes and precautions which you have shared will certainly help all of us approach the season with greater diligence and confidence. As always, you have been instrumental in sharing your thoughts. Thank you so much, and for taking out your time from your busy schedule for each one of us, and to each one of you too for joining us today. Have a great evening. Thank you so much.
Thank you everyone.
Thank you, sir. Thank you so much for taking your time.